Mm. Yeah, so I mean, the obvious one and the easy answer, which we all turn to, is Amazon, Facebook, Apple, Microsoft, etc., etc. And that's not untrue. That certainly is. But I was doing some digging on the weekend, and two things really stood out to me. The first is the fact that the momentum or the price action has been driven by around about a third of the stocks, and most notably, of course, the big heavyweight stocks. Those couple I mentioned up front, Alphabet would be in that list as well, is actually not that uncommon. What's very uncommon is when you find a majority, sort of 80 or 90% of stocks making those highs and pushing it higher. That's actually the uncommon part. Typically, it's somewhere between a third and maybe 50 or 60%, whilst the others are lagging. And that partly because markets go to winners. The way indices are constructed, you find that the big caps are always going to be the ones doing best. That just kind of, in a sense, makes sense, because if they weren't, they wouldn't be those large caps. And when things turn, as we saw happen in March, well, they take you down on the downside as well. But for example, I mean, two stocks that are also hitting all-time highs was Target and Walmart. And on the surface, you think Target and Walmart, I mean, those are old school sort of grocery trains. And partly it's because during hard lockdown they were still operating, etc. But actually, if you delve into it, what both of them have really done is get their delivery, their online presence working incredibly well. Walmart, we know, has Flipkart in India, which Naspas had a stake in, which they took from Naspas and others, Naspas via one of their arms. So they've got presence there. But they're doing same day delivery. They're doing a prime competitor, which is what Amazon has. Target saw their online sales increase almost 200%, and just really good sort of bricks and mortar for those two businesses. But their online business is picking up, absolutely booming along. And I think that's intuitive, because we kind of think it's all of these new stocks, and it is largely it is the Facebooks and the Amazons and the rest, but there's a bunch happening down there that's also doing really well. Hardware Depot, they don't call it Hardware Depot, I forget the name, and Lowe's, which are sort of like your hardware stores, your DIY stores, also both hitting all-time highs. And that, I suppose, people were locked down looking for something to do, so they went off and did some DIY and the like. So although it is sort of only just over a third of stocks that are making those new highs, it's really there's more to it than just tech stocks. And although a third is on the lower end of the range, this is not uncommon. We saw it in the immediate run after the crisis into 2010, 2011. We saw it in the initial days of the .com. Certainly was there back in the late 80s, leading up to the collapse of 1987, where sort of a small subsect of the broader market pushes it. It does mean it doesn't mean that we can't just discount and say, truthfully, there's a large swath of the market that you might have been invested in that isn't doing so great. And that's why I always structure my portfolio. At the core of it, I have ETFs, because they give me the market, and then I go and try and pick a couple of individual winners around it. But I always like that core of ETFs. So regardless how your personal portfolio might be doing, if you've got any Nasdaq, Ashburton 1200, S&P 500, MSCI World Index, if you're holding any of those, you're doing good right now. So I like the shoplifting analogy, and just for some perspective, Apple hit 1 trillion in August of 2018, and then hit 2 trillion in August of 2020. So double quick speed, and now sitting on a price earnings of above 30, which no longer the cheap stock it was a couple of years ago when it was sort of low double digit. So what happened with Fortnite is they sell things for in-game purchase, and it doesn't make you a better player. Apparently, it's just like different skins and stuff like that. And then Apple, because you're doing it via the Apple App Store, and Google does the same, they take 30%. And Fortnite was like, well, hang on a second. So what they were doing is they were sending users outside the ecosystem to buy these in-game tokens. And Apple's like, nope, you're circumventing our license, and therefore we are kicking you out of the Play Store. And this is a bigger story for the likes of Apple and truthfully Google, although on an Android phone, I can sideload software so I can get it without going through the Play Store. Europe is investigating this as anti-competitive. And now Epic Games, which interestingly is owned in part by Tencent, which of course brings it back to Process, which is the angle for South Africans, kicked them out of the store. It was obviously carefully planned by Fortnite. They had a video ready. They've gone to court. And the court case is going to play out over years, because ultimately it'll end up in the Supreme Court, because they're charging with antitrust, and that's going to have to go to the Supreme Court unless Congress does something beforehand, which is unlikely in this particular case. And it really is Apple saying, if you play in our garden, you play in our rules, and we charge 30%, and that's it, no debate. And a lot of other people saying, Fortnite obviously at the forefront of it, saying 30% is actually just too much. We don't mind paying you a fee, but we do mind paying 30%. Now, make no bones, Fortnite makes a large amount of money anyway, but it's going to be interesting to see who blinks first, if either side. Will Fortnite blink because they'll have a new season coming out and they won't be able to update it to their Apple fans? Does Apple blink because they worried about the court of public perception? Or does this really play out in the courts of America? And either one of those is going to be fascinating to watch. In the immediate, it's done nothing to the Apple share price. The Apple share price hasn't moved at all. Fortnite not listed, so we couldn't see anything happening in terms of that. And I think Microsoft coming out and kind of supporting it. With respect to Microsoft, they don't have a Play Store or anything like that. So really, I think they were just kind of poking one of their competitors in the form of Apple and Google, who they compete. Apple with software, Google with search. So I think Microsoft is just having an easy sort of prod at their competitors. Yes. Hmm. Yeah. Yeah, that's a great point. And let's touch on the first one first. I mean, so it's also partly, the sort of September, October is end of their summer season. Summer really peaks for Europe is this is it, it's August. But obviously, there was a lot more expectation. And it would be more than just holiday travel, it'll also be business travel and the like. But what we're seeing, and as you mentioned, we've been looking and talking about this over the weeks and months, is that in essence, part of the trick is that some countries are opening up and then having to go back down. We're looking at Spain mobility here, lots of driving happening. Public transport has actually been trending down since having sort of peaked in late July, early August. And I suspect, I mean, Spain's getting reemergences of COVID cases, and so is France. In fact, France is now clicking along at a similar level of new cases per day as South Africa. And we're similar population size, both countries about 60 million. So suddenly, borders are starting to be closed, or if not closed, quarantine. The UK is saying if you come in from certain European countries, you've got to quarantine for 2 weeks. So suddenly people don't want to leave because when you come back, there's that quarantine. You had a great holiday and then you spent 2 weeks in a hotel room at Gatwick, or you went across the channel for a business meeting and you basically can't get back home. So I think this is not unexpected. It's sort of thing we saw coming, we thought would happen as the pandemic sort of comes in waves. And even if the second and third waves are not to the level of the first, they're still going to have implications. But I like the second part of your question. What does travel look like down in the future? What is particularly airline? And I think it is going to be fundamentally different. We were talking before we came on air that the restaurants and the like in Joburg, and I imagine countrywide, were packed this weekend. By all accounts, absolutely as packed as they could be, obviously with social distancing and the like taken into account. That's one thing to go to a restaurant or to go to a friend for a braai, or maybe even pop into your... Yes. Oh, yeah. I was a coward. I went to a friend's house, so there were only three of us, so that was nice and easy to do. But I think it's different. Look, going to a restaurant and not social distancing is just crazy. But yeah, I'm going away this weekend, and I'm going to reserve. It's a 2-hour drive away. The idea of getting into an airplane to me just still seems too crazy, and I think airlines are going to absolutely struggle. In the one sense, they've got to try and make it cheap, but they can't do that because they haven't got capacity. And what we've seen, and this is a story I often use, back in March of 2000, so 20 years ago, I flew Durban, Cape Town, and I paid 3,500 Rand for that air ticket. I can now do Joburg, Cape Town, before the pandemic for half of that price. And air travel had just become ubiquitous, and suddenly it wasn't only the prevail of the rich and the well-heeled. And I think what we're going to see is lower capacity, less aeroplanes, less airlines, less flights happening, therefore, frankly, higher ticket prices. I think airline travel, certainly for the next couple of years, is going to have to sort of give up on the idea of get as many people as possible into the airplane, and as many planes as possible, and go back to the old way where actually you charge a premium price for it. And where that leaves the likes of Ryanair, Kulula, Mango, those budget airlines, I think they're going to absolutely struggle. I think air travel is going to be one of the last to really return back to those sort of pre-pandemic levels, as people just remain concerned. And I know that the stats, in an airline and the way they recirculate the air and everything, but yowza, I'm a long way from getting back into an aeroplane, and I think that's going to be in a lot of cases. Notwithstanding, of course, that businesses and consumers are under pressure, and we've all discovered Zoom. So, do we need to go to Cape Town for a meeting? Yeah. Mm. Yeah, and I put Japan into the show notes because you're right. We talk a lot about Western Europe. We talk a lot about North America, and of course our home country, South Africa. But Japan, which is third largest economy in the world after the US and China, is one we don't typically touch on, and that's not just us. That's globally, partly because Japan has had a tough 30 years. That they've had quantitative easing now for 2 decades. They've been unable to get inflation going. They've got an enviable saving record amongst their citizenry. The problem is that there's an argument that they simply save too much, and the reason is, if in low inflation, or worse, a deflation environment, you're not compelled to spend, because in 6 months or a year the price will be the same, or perhaps it'll actually even be cheaper. And it's a massive, 28% in the second quarter is huge. Consumer spending over the same period off 8.2%. Japan had hard lockdown. Different prefectures did different level of lockdown, but to a degree they were somewhere between hard and fairly hard. So they certainly had their lockdown. And it's just an economy that's been unable to get going since their crisis of what was then the 1980s. And I then wonder, does this sort of set them back even a bit further? I'm looking at the Signia Japanese ETF at the moment, and it's been doing okay recently. And in fact, the Nikkei 225 has had a fairly good run over the last 5 or 10 years. In fact, maybe even a bit longer, since sort of like the early aughts. But how does their economy respond? Are they able to come back from this? They were, to a degree, they didn't suffer as badly in the 08-09 crisis, partly because they already had their quantitative easing to a fair degree, and just because of the high levels of savings and therefore lower levels of debt by the Japanese consumer and population. But does this set them back? Does this sort of, their recovery, which has been modest at best, does it take a big hit? The market is taking it in its stride. Japan's also doing some interesting things and worried about the rise of China. Early in the pandemic, when supply chains were all being challenged, they put together a fund basically saying to Japanese companies, if you bring manufacturing back into Japan, we will help you. We will pay for the factory. We will give you tax credits, etc., etc. Particularly taking manufacturing that had been in China, in Vietnam, and other parts of the broader sort of Asia Pacific rim, trying to bring that in, trying to get that going. But it's something, I always wonder if Japan, because their crisis was so much sooner, is Japan perhaps almost, maybe this is what Western Europe and North America become with, 2 decades of failed quantitative easing. Failed in the sense that we never got inflation going, and always worth keeping an eye if maybe the Japanese outcome is perhaps not an outcome for other swaths of the world at the same time. Yeah. Yeah. Yeah, and you make a great point there, Danae, is that for all the critics around quantitative easing, and there's certainly lots of criticism around it, they're kicking the can down the road and everything else. Quite frankly, it has worked. I mean, it's kept Japan's head above water. It's kept Western Europe and North America, and much more so the United States than anywhere else above water, even though we're now in year 12 of it. But as you mentioned, kind of like you kick that can down and then you just get to the next crisis, and then it's QE on QE. Now, as a classic economist, this is the most terrifying thing in the world. But then we look at Japan, who've been doing it for decades, and there's a lot to critique Japan. There's a lot of challenges in their economy, but it's an economy that functions. It's an economy that remains the third largest in the world. It's an economy that, by many metrics, kind of does okay. And then suddenly, maybe QE is just kind of the way of the future. At some point, you kick that can down the road and it rears its head and bites you. But maybe this is just what capitalism does for the next. I mean, who knows how long? I don't know, but it does suggest that the detractors of QE are not necessarily their arguments have validity, but that QE also does actually to some degrees work, as much as the idea of negative rates and flooding markets with money is a terrifying idea. It seems to do what it says on the sticker for now. Yeah. Yeah, it rushed through 2000 to 2060, 2080, pulled back into the 1900s, and seems to be settling sort of the 1950 level, maybe down to 1920. I don't think that's unexpected. Earnings season in the US was better than expected. Highs in the markets take some of the shine off the case for gold. Of course, the flip side to that is that there's also, the quantitative easing continues, but as we just mentioned a moment ago, that's been going forever and a day. I think the story for gold remains. I'm long of gold via stocks rather than via the actual metal itself. Pan being my preferred, Pan-African resources in that space, and I think a pullback, and perhaps even a sustained pullback, and frankly maybe even down into the 18 or 1700s, is not to be unexpected. The move to gold to above 2000 was swift and strong and fast, and nothing goes up forever. At some point there needs to be some sort of comeback to normality. And I think that's what we're seeing in gold right now. And certainly, if I were, I am a gold holder, if I were a direct gold holder, I wouldn't cause this to stress me. Gold's got a story behind it that in a pandemic plays well. I've never been a fan of gold, but when suddenly there is a pandemic and gold is moving, there's definitely a case for owning gold stocks. They've done well. This is just a breather in what I think will be probably a good couple of years for the sector. Yeah, so I mean, the credit loss ratio is the first number I went to. In Standard Bank, it's 1.69%, 169 basis points. That's a giant number, but also, you know, they did put 500 million centrally just for sort of more bad debts, etc. To your point, the question is, what about those debt those repayment holidays and the like? What happens as those holidays start to expire, which are obviously going to be happening in the current half, and we just don't know. Certainly, we're at levels where the numbers are, you know, those credit loss ratios are as bad as ever, but they're telling us historic. And what struck me, and ABSA came out this morning, and the same story with ABSA, is that if you pull out the bad debt ratios, the bank results aren't bad. I mean, and of course you can't. I mean, you can't just pretend the bad debts aren't there. But the bad debts really are beyond the management. You know, no one foresaw a pandemic. No one foresaw a hard lockdown. And I note from ABSA's results, the comment they made. So their bad debts went to 277. So 108 points ahead of where Standard Bank is. And ABSA said, and I quote them, the second half credit loss ratio is expected to improve significantly. In other words, what they've done, and we saw it with Standard Bank as well, is they've been very aggressive in their write-down of debt. Standard Bank put $500 million into a central pool to manage it. So if these bad debt credit ratios really have peaked, then actually the banks are going to come through this perfectly fine. And you know, I'm not suggesting that the banks were under any risk of going bankrupt or anything. Truthfully, I don't even think they're at risk necessarily of slipping into losses. But maybe kind of that sort of second quarter of this year it was the absolute worst, and we can get past it. What I'm watching is two things: the net asset value per share, because that's a price to book, and our banks are currently trading below book value for at levels not seen in 20 years. And interestingly, both on ABSA and Standard Bank, cost to income ratios have come down. So what this tells us is that the banks are using the crisis to really sort of get into ship shape. Now, they were in good shape beforehand. Their capital adequacy ratios have been well ahead of requirement. We've had really good banks forever and a day, helped in part because of the crisis of '08, the National Credit Regulator, and other bits of legislation. They're fairly strong. They're sitting fairly well, and it really is just going to depend how bad those credit loss ratios get. And in the meantime, cost to income and net asset value per share, because those are the numbers that will matter once we're through. The credit loss ratios will, eventually start to come down. What will be telling is how quickly or slowly they start to come down. But our banks are very, very well positioned, and as they have been since forever and a day, they remain strong and very well capitalized. Yeah. Mm-hmm. Yeah. The one thing to watch out for, which is property stocks, because obviously the banks have got a vast amount of debt instruments issued to listed property stocks. If we start seeing serious pain in property stocks, that could filter through to the banks. So far, property stocks are managing it; they're hurting, but they none of the biggie banks significantly. Yep, it's Coza. Yep, it is. I so I thought that too, but this is Northern Cape, so no Kele in Northern Cape. Quarrying, aggregate, yeah. I think so, and I mean Afrimat. This is their sixth or seventh deal since they listed in 2007, and they have 100% track record. They do deals that work, which is astounding because the global average is like a third of deals or M&A activity actually works. Afrimat, Andres van Heerden and his team make it work. They bought a little iron ore mine a couple of years ago, and it's been doing incredibly well. This Coza business is very much exploration, so it will be greenfield projects, but it's adjacent to their existing iron ore mine, which has a 10-year life of mine. So this extends that. And what Andres will tell you is that they're ultimately they run quarries, right? Aggregate and the like. They dig up stones. And his argument is that that's not much different whether you're digging up stone or iron ore. And this is high quality iron ore. In the case of the Coza acquisition, Arsenal Mittel SA has got an offtake agreement, so he's got a market to sell it into. And they just their deal making activity works. He absolutely has the track record to say he's done it before, and he and his team can almost certainly do it again. So I think a really clever little deal for them. And then interestingly, I was chatting to Andres van Heerden, the CEO, last week, and I was asking him about tender activity. Now they don't directly tender because they supply aggregate and the like into the industry. So a company gets the tender and then comes to Afrimat. But he says they're seeing peak demand. He says absolutely, because all the talk globally and in South Africa is about massive infrastructure spend. Sanrail's been talking about 20 billion. The Eastern Cape's been talking about spending billions. And he says they're starting to see those tenders coming in. It'll be a little while before it trickles down into Afrimat. And the point with this sort of business is with aggregate, it's about proximity. You need to be close to where the work is happening because moving a truckload of stones across the country is just not economically viable. But they do have 25 quarries around the country. I was amazed. I thought it was maybe 6 or 8. They've got 25 quarries. So Afrimat's back at all-time highs, and frankly, a stock for investors to keep a close eye on. The Coza acquisition will work. They're probably going to start picking up some activity in the infrastructure space, and they are, I think, one of the best management teams on the JSE. Yeah, that's a great point to know. I mean, we were mentioning airlines a moment ago, and how are they going to, airlines are not going to suddenly go into, I don't know, retail, or actually never say never, but how are businesses going to adjust, how are they going to change, and then watch out for mergers and acquisitions. For example, it's not on our rundown, but small story this morning, Famous Brands selling their 51% stake in Tasha's back to the founder who owns the 49. How are businesses going to reposition themselves, how they're going to slim themselves down, and how they're going to look coming out of the pandemic. Some are going to look a lot better and a lot more attractive as businesses, and they got maybe a bit bloated over the sort of decade before, and others are doing it and might actually come out looking worse for wear, but they did it because simply they needed to fix their balance sheet. They might have sold some crown jewels. We saw that with Sun International selling off their Latin American assets. I wouldn't call those crown jewels, but they're certainly jewels which 3 years ago Sun International would have said never would we sell it, and yet here we are, because frankly balance sheets need propping up. So they did announce that they were going to do it pre-COVID. So you're right, this isn't a COVID reason. But the problem that it was brand reputation, and it needs to get fixed up. They call it a value add meat product, otherwise known as VAMP. They could have picked a better name than that, I think, as well. But anyway. And there's still an ongoing class action lawsuit that continues, and Tigerbrands will defend it. They don't sell the liability with it. But I think a company such as Tigerbrands, which is very large and sprawling and has had some forays into Nigeria which failed, and I think we're going to see a fair bit of cleaning up of their portfolio as they try and become almost, in a sense, AVI. And it's weird because AVI was always the small kid in the stable of the large food producers, but AVI's proved their mettle, and AVI's taken a different approach during the tough times, which was defend margin at all cost. Defend margin. Tigerbrands came at it the other way, which was almost at all cost defend market share, which means margin squeezes. But the problem then is you've now bought a fancy ginger biscuit and you've paid a cheaper price for it. It's going to be difficult to get that customer back to paying the top price. Whereas AVI took the view, look, we will lose some market share, but when the customer's wallet gets fatter again, then we will quickly pick it up, as we've seen as that sort of treat, that sort of luxury almost in a sense. You've got your favorite auntie coming for tea, so you get the good ginger biscuit type of scenario. And famous Tigerbrands has had a very, very tough couple of years. Listerosis being obviously at the heart of it. And I think they were some way for them to really clean up their stable and to come back. I mean, the AVI share prices had an equally tough 2020, but it at least is trading 3 or 4 times the 2007 levels, whereas Tigerbrands is back at 2007 levels. Yeah. Yeah, agreed 100%, making it an attractive investment proposition again. Yeah, so both Curro and I'm not sure if it's Curro or Curro, so I'm going to take my lead from how you say it. Both them and ADvTech have started online-only schools, and ADvTech's kicks off in January. Curro's is already up and running, started a month or so ago, and I think those will become significant, but not in the short term. That will, in 5 or 10 years, perhaps that will be really, really significant. They've obviously got advantages in that they're independent schools. They've got balance sheets behind them. They can manage pandemic and what comes with the pandemic and the social distancing, etc. probably better than I think a lot of government schools, even the Model C government schools, which are really struggling. And of course, here we're not even touching on the poor government schools who, let's be quite honest, are struggling, way before COVID ever reared its head. They're well positioned, but of course, typically what you say, under normal circumstances, you would say, one of the last things a parent is going to do is cut back on the education of their child. They will sacrifice a lot for their child. And that statement rings true. But that statement was never made during a pandemic. And a parent might want to do the best for their child, but just circumstances, perhaps your income has been decreased, perhaps your income has disappeared and you've lost your job. Double income households might now be single income households, and it's just not practical. So certainly, Curro, ADvTech have both seen it. I thought the ADvTech trading update was a little better than the Curro numbers, although truthfully, it was just an update from ADvTech. We need to see more there. We also need to get a better view of, sort of the longer term impact, full year numbers. But in the case of Curro, so they did 40 cents HEPS in the first half. Normally you just double that, but I think they're probably not going to get the same for the second half. I think there's going to be a lot more defaulting. They're also doing discounting. Your admin, your application fee, they've discounted it by 50%. They are engaging with parents to rather lose some income in the short term than lose a student, because typically a student will join a school at, say, grade 7 and go all the way through to matric. And if they exit out, they're probably going to stay at the school they went to. So it's really important that you hang on to them. And that's going to hurt in the short term. I think that bodes well for them in the longer term. If Curro's doing 50 cents, maybe 60 cents, although the share is back at where it listed in 2011, that's not a bad forward multiple. ADvTech, same story, probably not bad multiples. It's going to be a tough 2020. It's probably going to be a tough 2021 for them, but they'll come through okay. ADvTech's balance sheet is fine. Curro is going to be doing a rights issue at R8.07, which will store up their balance sheet and perhaps give them some opportunity for acquisitions. I don't know if that's a great idea, but education remains critically important. And in South Africa, our private school, the numbers run at about half of the global average. Now, of course, South Africa has its own unique challenges in terms of poverty, in terms of the gap between the haves and the have-nots, which are significant. But I do think that education remains a good story, and I think that I prefer ADvTech, but I think almost either of them. That said, that doesn't mean we need to rush off. I don't think these shares are going to, they've rallied off those lows of earlier in the year. I think it's going to be a while before we start seeing significant share price appreciation happening here. Mm-hmm. I think you're right. And as you said earlier with the airlines, schooling, how do we imagine it different? And I think there's many ways we do. The one that struck me, which surprised that wasn't implemented, is why didn't schools break into two shifts? Do a 7 a.m. to 12 and then a 12 to 5. And maybe the reason is teachers and administrators and everything. But how do we reimagine the way that schooling actually works from a just good old fashioned practical perspective? Mm-hmm. Yeah, so in the reason why, and we're looking here at PSG do a sum of the parts, which they update. I think they actually might update it in real time, or certainly, no, it's not, yeah, it's real time. It's actually for today, 24 August. And it shows that, of their net asset value, 67% is Capitec, which really then kind of dilutes all the rest. The Curros, the PSG Consults, the Zeda, the PSG Alpha, which is their little sort of startup business, and other bits and pieces. So what they're doing is they're spinning out Capitec. There's also some issues around, because they are a shareholder of reference. The Reserve Bank has requirements, or in terms of the banking regulator and the like. So if you hold PSG at the close tomorrow, 25th Tuesday, for every 100 PSGs, you'll get 14 Capitecs. The PSG price will fall. How much will it fall by? So back of the matchbox for me is that PSG is probably falling to around 40, maybe 45 Rand, but you'd have those Capitec shares. So in theory, you should be better off. We should see some of this discount close. And the discount has already, the discount has been as wide as over 35%. It's now come back to around 18%. So there's, still some space to close, but not necessarily that much more. What then happens to Capitec? So that gets curious. So a lot of people are going to now hold Capitec shares, which they previously held indirectly. Do they go to market and sell them? I think a lot of people probably bought PSG as a cheap way to get into Capitec. So therefore, no, I don't think there'll be that much selling. Also, the Capitec free float increases. And what I mean by that is that stake that PSG was holding, which was 30-odd% of Capitec, for the purpose of building indices, the JSE doesn't include that in the market capitalization of Capitec, because it's not tradable, because it's held by PSG, and PSG had no intention of selling it. Well, now they do. So they unbundle it into the market. So the Capitec free float goes from about 45% up to about 60-odd%, 67 if memory serves correct. And what that means is that it actually takes a bigger weight in the top 40 index as well as the FINI 15, which means that index trackers will start to pick up on it and start to buy it as well. So this is one of those weird scenarios. Usually in an unbundling, one does well, one doesn't. I think, actually this could be positive for both Capitec and for PSG. PSG longer term, the PSG has been talking about what they call 3.0. PSG 1.0 was the initial sort of PSG years. 2.0 was, I suppose, post sort of 2010, when Capitec became the juggernaut it is today, and now the 3.0, which is, they no longer have Capitec. Importantly, they also no longer have dividend flows from Capitec, which was about R500 million a year to PSG, so not insignificant. But I think probably good for both parties. I hold Capitec, so if I was holding PSG and I received Capitec shares, I would more than happily continue to hold the Capitec shares. It's come under some pressure. Have banks, but it's held on to around about that sort of 800-900 Rand level. Mm-hmm. Yeah. Yeah, I agree with you 100%. And, every CEO at some point quits. Man, this is when you want to exit, when your share is at all-time highs. And the chart on the screen now, it's more than just all-time highs. It's kind of almost double what it's ever done before. It's off the absolute highs of 280 or 260 rather earlier in the month, but we spoke about gold earlier in the show. Gold has been coming back a bit, and yeah, he's done a good job here. He's kind of got South Deep mostly working, which really has took 10 years longer than anyone ever thought. Literally 10 years. That was Western Areas, which Jill Marcus was actually the chair of before she went to the Reserve Bank, and then of course she went to ABSA for a while. So it absolutely has been a stellar year for him. He's also the snappiest dresser of all the certainly of the mining CEOs. If ever you've been in a TV studio with him, he makes everyone feel underdressed in a sense. And he's done. This is the time. If you those were absolutely stellar results, and we expect nothing less. Of course, we want them. Gold price at record highs. The rand is weak. We expect stellar results, but he produced it. He's done it. He's left the company in fairly good shape, and kudos to him. And I hope he takes some retirement and enjoys some sort of lazy days after being a hardworking miner for the last couple of decades. In many senses, we're losing our old school miners. Anglo, for the last two CEOs, Anglo Gold Ashanti has had an accountant as a miner. The days of Bernard Swanepoel and Neil Frontman, of course, Neil's still at Sibanye Stillwater, Nick Holland, the miners who wore boots to work, although not Nick, he would never wear a pair of boots. Maybe he would wear them down a shaft, but not into the office. We're kind of losing the sort of old school miners, and I suppose that's just the accountant sort of taking over the world to a degree. Mm. Bank, they decided to be an African bank. And not without its challenges. We touched on Tigerbrands. That's been a disaster for them. But I think MTN's got good presence. I agree with you. I think he's a great appointment. From chatting to the few insiders I know at MTN, he's liked amongst the staff, and his background does raise the odd wry smile. But he's been at MTN a bit. He's certainly got continental experience, and all things. I think it's going to be. I think it looks like a good appointment for MTN, and hopefully you talk about their small fires that they've got burning. And it seems like almost all over the place. Hopefully, on the sanctions and just a messy market, accusations of helping the Taliban in Afghanistan, lots of issues for him to moving you, or whether he's going to take the value-added services. I hope the four need to be utilities, ultimately utility. Then they. Yeah. Agreed. Oh, we forgot a quirk. Yeah. I am in summer. Yes, if we're lucky. we we hold thumbs and keep our social distancing. It increases our odds of getting December summer pool parties. Cheers, Dino.